Welcome to FinTips, everybody. How you doing today? We're going to talk about rebalancing. Don't you like our thumbnail? That's pretty sweet.
I think it looks really, really cool. So
I had
somebody around here step their game up.
Well, we were trying some different things, right? Mm-hmm. So I had the guys play with a couple different thumbnails.
Okay.
Would you like to see our other one?
Yeah, let's see it.
Let's see if you like this one.
Change it on the fly.
Do you like this one?
That's funny.
We just thought, maybe this is something.
That is too funny.
That's you.
Yeah.
That's me. Right? It looks pretty good.
That is too funny.
I think we're going to go with something like this.
That is awesome.
I tell you what, do you know this guy's name in real life? What's his name?
Yeah, there's Bo and Brian.
Okay.
No, Brian.
I
met him. Out in
Okay.
Texas. I told you I met him.
Me and him got it going on. I'm telling you, we're some good-looking dudes right there.
He's a really nice guy.
You guys, that's a little too much Hollywood for me, man. You know what I'm saying? We're the good-looking studs.
Is that what it is?
Yeah.
We got the top buttons, so we're doing our
Yeah, you do the thing there. See, we're
like
laid back. He's got the beer and stuff. We're the good-looking dudes.
I
Don't
got
worry, we know how to run the show there. Anyways, let's go back.
All right.
We're going to talk about rebalancing. Changed it up on you, see? Instead of a joke that makes you uncomfortable, change it up and go with
that was funny.
the good-looking dudes there.
There you go.
Man, what a good-looking couple. All right. We're going to talk about rebalancing here today. We're going to make this really quick because there's a lot of data, and I spent a lot of time on this, so I want to make it clear. When should you rebalance your 401k? If you had to guess, do you know the answer?
I don't know the specifics. I'm curious to hear what you got there. But, generally there's a quarterly rebalance, or there's an annual rebalance, or there's a drift, depending on how much it drifts.
Yep.
So a lot of people talk about the drift.
Yep.
So I'm curious to see what you got and why.
So a lot of 401ks, TSPs, things like that, they have an automatic setup. You could say rebalance quarterly, I don't think monthly, or annually. And so we wanted to kind of look at that and see, okay, what's the best way to go about it? To do that, we wanted to choose funds that are the most common in every 401k out there. You're usually going to find Vanguard. They've got their little fingers in everything.
Yep.
And so what we did is we said, okay, let's just not pick one and then, one fund could have done better. So we got a nice even split here. This is the equivalent to like a 20-40 at the time of this video, 20-40 type mix. So you got everything in there like you would see if you said 401k, automatically choose me, the best ones to do. We based it on our audience there, average age.
Now you mentioned real quick, I just want to clarify this. So you said a 2040?
2030.
2030?
Did I say 2040?
Yeah.
Okay, it's 2030 because we wanted somebody, I was trying to get somebody that was in their 50s.
Okay.
Is that
okay?
2030?
Or you're saying like a 70-30, kind of like a 60-40 breakdown, like stocks?
Right in between. Yep.
Okay, gotcha. There you go.
Okay.
I was trying to figure because I know if I'm like, what in the world is he talking about? Maybe you're like, what in the world is he talking about? Or maybe you got it.
I do that.
Cool.
I do. I say things. What's funny is if I say something wrong, people are usually like, hey, bud, you meant to say 2030. But if you say something wrong, they're like, who the hell is this guy? Like,
yeah. Who's the other guy? Who's the other guy?
You get
the
beat
other
up.
Guys.
People know. I sometimes say things.
That's right.
Okay, so that's our mix, and here's what we're going to do. If we rebalanced based on a monthly, quarterly, annual, or never rebalance, here's the data on that one. So if you never rebalanced, your average returns based on that portfolio would be 10.07%, 26% over this time period here, which we gave it 20, which will now be 28 years, just because it goes back. If you did a monthly rebalance, then you averaged 0.75%.
No way.
Yeah.
Wow. Over 20 years, if you did a monthly rebalance, it's telling you that's what you're going to get. Because there's the robo-advisors who talk a lot about, we auto rebalance all the time. Like there's that consistent.
Wait, where'd we go here? Oh, no, here we go. Okay, so never rebalance. This is based on the drift here.
Okay.
Monthly rebalance based on drift. You're adding, or you're essentially adding to your core 0.75%.
So your average there is 10.07.
Yes.
So then you're adding this above your average there.
Yeah, because this has no rebalance. Yeah, there's no ever effort there.
Okay.
Then we've got quarterly, and we've got the annual rebalance there.
Okay.
So the difference is what we're trying to show here. The difference of 0.75% as an average over the long term average over the long term, average over the long term. I think there's one more. Did I go? Yeah. And this is the drift-based model. You just said a second ago, what happens if you don't have a time frame, but you say every time I'm off this allocation by more than 5%, I want to rebalance, which is also automated, I think, in a lot of them.
Can be, or just when you're putting the money in, it may auto deposit it depending on where your balance is.
That's true. Yeah, I haven't seen one recently where it says auto rebalance by drift. I don't think that's as common anymore. So here's your difference there. You can actually see the rebalances. You know how I did this with the white charts there?
Is that what you did?
Yeah, it's a whole setup that you
just
can do.
Fancy.
Yeah, just doing
fancy
what you do.
Charts.
And rebalance at 10% drift. So key number one, we'll take the data for people of you that don't like the charts there.
Yes.
So
I like this.
If you never rebalanced, of course, there'd be zero, right? If you had a monthly rebalance, you would have done this 300 times over the course of 25 years, right? Which would now be 28 years. Per year, of course, is once a month, 12 times. Quarterly, 104. Annual rebalance, 25 and 1. You get how that works. 5% drift, you would have done this 25 times or once a year. That makes perfect sense because you've seen the S&P, how often I show the different pullbacks in the markets. You get a 5% pullback every 0.9 years. So it makes sense that actually fits into the equation.
Nice.
And a 10% drift, you would have done only 7 times over 25 years. So we're not talking about, massive amounts of like paying attention and, oh my God, am I 10% off? Am I 5% off? You basically have once a year as your focus there. So that's the data there. And then here's the raw, total, I shouldn't say raw. Okay. Here's the total return over that whole time period. So it may be a little small there, but if you, we're going to start at the top. We've got purple. If you rebalance with a 10% drift, that's the best actual total returns.
Based on this, that's the best. There you go.
And we're, nice. We can only, I'm trying to base it on a generation of investing, not a generation, but your time frame of investing. So not saying let's go back 100 years. That's not realistic, right?
Yeah, and it's interesting because you incorporate in 08, obviously. You see 08.
COVID.
But then, we've got COVID up there, and then we've got today. So it's truly an interesting time because if you look, realistically, a lot of times you're talking through, 2000 to 2010 is basically not much of any return.
Yep.
But then you have this massive rebound after we fell from 08.
And look at it spread out, right? So the difference between what you do and the difference of your total returns, right? So it's not a whole lot, but these are the little things that you can do that had nothing to do with timing the market. It had nothing to do with you adding more money when the market was down or up or dollar cost averaging or lump sum investing. Had everything to do with how you rebalanced your actual account.
Yeah.
So we've got every time you have a 10% drift, which if I go back a slide, you're only going to do this 7 times over the course of your life if you have a 10% drift. So that's your best returns, annualized 7.43%. 5% drift, a little bit, not as good, but basically right there, right? It's within a couple percent.
Yep.
As you work your way down, an annual rebalance, if that's all you did, okay, you're not in trouble, right? 7.3 versus 7.4, you did fine.
Right.
Working your way down to the monthly rebalance, that threw me off a little bit because a monthly rebalance, now you're getting close to 0.5%, which remember over a generation, 0.5%, that's your biggest account value there.
Yeah.
That could be a lot. So I wanted to kind of point. Do I have one more? Yeah, here's actually the raw data just so I can show you. If you want to see through that.
You're such a good chart maker.
Thank you.
I'm not a good chart maker at all.
Well,
That's not my strength.
This could be one maybe we go further into, but just as a video to get you thinking there, where do you stand? The automated calendar-based rebalances perform the worst.
Okay.
So and that makes perfect sense because sometimes people will call me and they'll say, do you think we should get in the market? I just made a deposit. And I'm like, what are the odds that the very day that we happen to talk and you made a deposit is the best day to get in?
Right.
That's essentially what this is saying.
Yeah.
Just because it's the end of the month or it's the time of the month that you rebalance, you're actually doing yourself a disservice. Rebalance based on drift. So that's the big one there.
And what I'm looking at too with this, and another way to think through this whole thing, is if you rebalance at a 10% drift, basically your portfolio potentially goes to like a 70-30 for a little bit.
Yeah.
And that's where there's some discussion with advisors and risk tolerance and comfort levels because, in '08, let's say that you never rebalanced. Oftentimes, if you had a runaway here and then you didn't go into, let's say, a little bit of bonds, a little bit more conservative with your mix, let's say you're at 80-20 and you never rebalanced, you're taking that whole cut.
Oh,
it goes down. And so rebalancing does help with risk tolerance and kind of keeping things in line. But if you don't let it run a little bit, you're going to miss that ultimate, growth on the growth side with the stocks.
I will add to that and agree with that imagine, so this is your never rebalance down here. What's happening during that? Why is this getting left in the dust? It's because your stock position's getting heavier. Your bonds are dragging, of course, but your stock position's getting heavier. So it's keeping up. But what happens on every single dip? See how the green line, if we could just be super simple, the green line falls the most. And that's because you never rebalanced and your stock position is getting heavier and heavier and heavier. It doesn't really help you on the way up. But as soon as the market falls, you're the first and fastest to fall because you have more stock than bonds. You've essentially moved towards 70 and 80-20 versus 60-40. And so rebalancing to some degree is much better than never rebalancing, right?
Which on the other side of that, though, too, this is going to be still, if you don't rebalance, you're going to have more stock positions, the rebound's there. But what's interesting is what I'm looking at with this is, if you do fall, you may rebalance here, where you're going to take some of your bonds and rebuy when it's lower. So you're shifting to some bonds in higher parts, but then you're actually shifting to some bonds and some lower parts at different time. You're shifting to bonds here, stocks here. So
it's the opposite.
So
that's what I talked about on
opportunity there.
Jazz After Dark the other night, where we
buy low.
Yeah, we talked about that concept of people getting emotional on the way down and moving to slower investments at the worst possible time.
Yep.
So
it's shifting that.
There you go.
There we go.
That's all I got.
I like that. I like that.
Spent a lot of time on it. It was like,
Man, that's nice. No, I think it's a great presentation, and I got something for you here.
Oh, a joke. Okay.
Yeah, man. I got something for you. 2 fish are in a tank. One turns to the other and says, "Do you know how to drive this thing?"
Oh, God.
Cody said it was good. I read it to Cody. So
yeah.
I found a Reddit thread that has dad jokes.
I'll tell you what,
You know what? I got another one for you because I drink coffee. Just to give you one more.
Please don't.
What do you call sad coffee? A depresso. See that one? Maybe it gets you somewhere
that
there.
Was a little bit better.
You know what? I'll double down. If it's not good, each day I'll have a backup.
I didn't actually have a joke today, but you just made me think of one. Is it too late?
Oh, great. We got a joke. Okay.
No. You made me think of one. This is a good one for the kids, right?
Oh, thank goodness.
What do you call a magician dog?
Howdini. Wait. Howdini? No.
That's actually not bad.
Okay.
An abracalabrador.
Abracalabrador. I like that.
Yeah. Uh-huh.
Nice.
I don't remember where I saw. I'm like a bring. I have to remember all this.
Yeah. You get
on the next one.
Weird jokes in your head.
I'll have a magic trick instead. I'm not much of a comedian, but I'll have a magic trick.
All right. Let's see it.
I love it. Enjoy the rest of your day. Thanks for watching, everybody, and kudos to these handsome, this Hollywood over here. I can't live with,
the
man.
Mix there.
Yeah. Thanks to Kevin for putting that together.
It's too cool.
All right, enjoy.